One of the long-standing debates around the entire Philippine economy is the subject of trade. Trade, for the most part, has always been a deficit, which often happens whenever a country imports more than it exports. And the Philippines, as data from the Statistics Authority showed, that the country has consistently been at a trade deficit since the start of the 21st century, with a few years of exception. The latest data, however, shows that the Philippines' trade deficit has even turned into a fatter deficit. In 2020, a trade deficit registered at about $24.6 billion US. By 2021, at $42.2 billion, and by the latest year at over $58.3 billion. This means that the Philippines' import has been growing massively, whereas its export has not so much. For context, exports in 2021 were $74.7 billion, but by 2022, they only increased slightly by $78.8 billion. To most people's understanding, however, this can often be seen as a failure of the Philippine economy. They can and may indeed blame politicians, economists, and even businessmen for failing to act on this rather gleam outlook. After all, there are factual negative causes that a trade deficit may bring to an economy, which we will talk more about later. But for now, we must first address an important topic about the entire trade deficit of the Philippines. Why? Why is there such a big trade deficit in the country? Well, this can be explained simply after we understand how trade is calculated. Trade, for the most part, only accounts for goods, which are tangible. Maybe we can put it on a ship or a plane, and then it may come from China or the United States, then be sold off or used across the Philippines. Likewise, as it is a tangible product, it can be a commodity, or it can also be an electronic, such as a phone. Either way, this is the basis of merchandise trade, and in the case of the entire trade of the Philippines, the country is just not exporting enough of what it can produce domestically. There is not enough to balance its imports. Nevertheless, there is still a huge call to fix this, as some have noted that while it may have been a long plaguing issue, there is still a huge opportunity that can be developed to help address this gap. Now, let us go back to what drives the Philippines' trade deficit to increase. Other than the basis of not exporting enough, we can also pinpoint how global prices have been volatile recently. For instance, a key product that is being imported consistently is oil, which ever since the COVID-19 pandemic started has been trading at a higher range compared to the 2015 to 2019 pricing. Moreover, another key cause as to why could also be just due to the Philippines' large domestic demand. One of the biggest waves we have seen in 2022 was what some economists coined as revenge spending. This happened because Filipinos have stayed largely indoors for the past few years. With the opening of the lockdowns, a spending spree occurred throughout the country. Hence, the need for import has been pushed to help address consumer demand. An important factor, however, can also be pointed out in how there is an infrastructure gap. Due to a lack of infrastructure, particularly in logistics, the country and its export-oriented industries have made it difficult for domestic businessmen to export overseas. This can also be applied similarly to foreign investments and several policy and regulatory barriers. Whereas limited foreign investments also limited the export sector. For context, the reason why the Philippines even has a large $78 billion export in 2022 was also due to its semiconductor companies, which have a lot of foreign-owned companies such as Texas Instrument and Toshiba Information Equipment. Likewise, there is also a regulatory hurdle that impacts foreign investment and also certain policies, such as high tariffs. There are a lot of causes as to why the Philippines have a very big trade deficit. However, now this brings us to the highlight of today's video: why it's bad, but why it is also sometimes over-argued by some. Sure, it can also signify some possible issues within the Philippines. However, we must also add some facts about why some claims are not the case, which we will discuss further on. First, a trade deficit is bad simply because it can lead to economic consequences, such as currency devaluations, as more of its currencies are leaving the country to pay for imports than is coming in from exports. Secondly, sometimes it can also lead to debt. To finance a trade deficit, after all, one has to borrow money from other sources. Thirdly, it can lead to job losses, as there is less demand for domestically produced products. And fourthly, it may also reduce economic growth. But the most important basis for today's video, however, is going to be the concept of foreign reserves. As mentioned in the first economic consequence, to cater to the big trade deficit means the Philippines will need to send more money overseas than receive it. That means a $58 billion trade deficit in 2022 will lead to the country sending $58 billion out of its pockets, which most cases come from its foreign reserves. This is important because it has been the context of several arguments in the Philippines. Due to these, as some have claimed, it will lead to an economic downfall. But that is also a misconception, because as we will learn in a bit, trade is just one part of many other factors. First of all, as we noted earlier, trade is but a calculation for goods. It does not account for many other factors such as service, which is a very big industry in the Philippines, business process outsourcing, or the call center industry as some know. It does not account for remittances. Whenever a Filipino, for instance, in the United States sends US dollars to the Philippines, that too gets registered as a net inflow of money rather than an outflow. For context, remittances in 2021 are a whopping $30 billion. Thirdly, it does not also account for several other factors. But let us dive deeper into these factors that we talk about. The data we gathered will be from the Central Bank of the Philippines, which unfortunately has not published its fourth quarter data yet. So the basis of our reading will be from January to September as per the latest data. In this case, when we add all of these, from the trade of goods and services to remittances and BPOs, we will come out with a term known as balance of payment. It is the calculation of all inflow and outflow of money, accounting for all the factors involved. The data showcases that while the Philippines has incurred $58 billion in trade deficit in 2022, it has only incurred a deficit of $7.8 billion in the first 9 months of 2022. The report shows that in the first 9 months, the Philippines incurred a trade deficit of $54.4 billion, but also a service surplus of $10.5 billion, and further surpluses in incomes from primary and secondary of over $26 billion. In other words, in the entire current account of the country, only trade has been at a deficit, whereas all other factors are at a surplus. Moreover, there is also a net inflow of about $10.3 billion in financial accounts, which counts investments. Let 2022, however, not be the sole base for the BOP deficit. Since 2000, the Philippines has incurred more years of surpluses in balance of payments than deficit, which is why the country has an ever-increasing foreign exchange reserve, which shows how the start of the century saw the country with a foreign exchange reserve of just approximately $20 billion, but in the past few months, nearly $100 billion. But anyway, we can now understand and embattle the forces behind those who claim that the trade deficit has been causing havoc for the Philippines. Although this video does not imply that the Philippines' trade deficit is good. Rather, we are even seeing large government interventions such as more trade deals, stimulating economic growth, and the attraction of foreign investments in export-oriented areas. There are a lot of fixes that still need to be done to properly put the Philippines in a better shape. Having a rather more balanced trade can suggest that the Philippines may either afford to import more without any worries, or even have better debt management when it comes to foreign debt. However, what the video is implying is that we must never forget that the entire trade deficit is causing havoc in the Philippines, but it is being balanced not by the exportation of goods, but by the exportation of services and the ever-increasing overseas economy driven by the overseas workers. Moreover, this does not also account for financial accounts, which are also slowly helping alleviate the entire balance of payments. So do let us know what you think. How do you think the Philippines should fix its trade deficit? Or do you have another theory or opinion as to why the Philippines' trade deficit is very bad for the economy? Let us know down below. Thanks for watching.